Well, good morning, everyone, and welcome to the Bloomberg Price of Power special, looking at the global energy crisis. I'm Francine Lacqua here in London. Now, taking a pause, oil fluctuates after 7 weekly gains. Saudi Arabia boosts prices, signaling confidence in demand. Europe's Russian gas problem. Well, no signs of de-escalation between Moscow and the West over Ukraine, the continent's energy dependency in the spotlight. And UK energy watchdog Ofgem amends its price cap regime, while British households could face a worst squeeze ever. This hour, we speak with the chief executive of energy provider Ecotricity. Now, Brent crude fluctuating in Asia, trading today following a run of 7 weekly gains that pushed oil to the highest level since 2014. So here to take us through what's up with oil is Bloomberg's Danny Berger. Danny, first of all, how tight is the oil market right now?
Francine, it's so tight that currently we are in super backwardation. Not only is it industry speak, but just frankly, it's a very cool phrase. Essentially, this means that the curve is very steeply downward slope, so traders are happy to pay up for contracts now versus into the future. The fundamentals do support this very, very tight picture. You have extreme cold in the Permian Basin, which means that that's curtailing U.S. output. There are questions as to whether OPEC Plus can hit its output targets, and of course, geopolitical concerns that continue to add risk to the upside.
So I guess, the million-dollar question is how high do traders think it can go?
There are very high bets at the moment. We've heard a lot from Wall Street saying a triple-digit oil. $100 really isn't that much of a stretch at the moment, considering we have Brent in the low 90s. Francisco Blanche over at Bank of America continuing to say 120 we could see on oil. We heard J.P. Morgan last week join in on that call if we have increased geopolitical tensions. And at the moment, option traders have gone wild for really steeply priced oil options. The amount of $100 calls right now is equivalent to 112 million barrels of oil, and options for 150 and 200 striked calls have quadrupled since the start of the fourth quarter. So these are some really big bets in the options market.
Huge bets. Danny, thank you so much for Danny Berger there with a look at the charts, looking at some of the things that we should worry about. Now, we're joined by Jeff Currie, Global Head of Commodities at Goldman Sachs, and Fiona Boal, Head of Commodities and Real Assets at S&P Dow Jones Indices. Thank you both for joining us. Jeff, I know you have a $100 call. When can we reach that point?
Right now, the upside risk in this market is exceptionally high. One of the reasons why, is alluded to, the markets are incredibly tight from a physical perspective. Whether you see it on the refining margins or in crude oil itself, the entire complex is extraordinarily tight, reflected in that super backwardation. Obviously, what it means is that this market is incredibly vulnerable to any type of supply or demand disruption, very much like what we saw in European gas and power, let's say late last year. So oil has now teed itself up, to look very similar to what European gas and power looks like. That was what we highlighted this risk back in October of last year. We're at that point right now. And so the question is, can you come up with any supply or reduction in demand as you move into the spring to be able to ease the situation?
All right, let's get to Fiona, and then I want a bit of a timeline from you, Jeff, about when we could see this happening. Fiona, what are you expecting in terms of prices by year end and from now and then?
I think, as Jeff said, we're really in a very tight situation. We talk about being at tank bottoms, so we just don't have that leverage if something goes wrong. So if we see, continuing situation, I would expect, prices to remain, around where they are, but there is definitely the risk to the upside, and it's not insignificant.
So, Jeff, talk me about, I don't know whether we can talk about sequencing in the price of oil, but once it touches 100, are you expecting it in the next couple of months? And then what happens? Is it a trend of higher, or could it readjust?
Well, it's difficult to say, in terms of what kind of, demand is far stronger than I think what anybody thought, because the Omicron impact is not as significant as even we embedded in our models. And then we look at the supply situation, the continued underinvestment in supply leaves this market incredibly vulnerable. Now, the question is, what is the upside limit here? One thing I like to keep in mind is if we think about the amount of liquidity in the system today, and we look at oil versus liquidity, the run up we see in Canada, you don't even see it on a picture. because the liquidity so overwhelms the movement in oil and commodity prices. And a lot of people go, okay, look at oil as a share of GDP. Let's think about it in terms of liquidity, because that really determines on the ability of the system to be able to deal with these price increases, particularly when some of that liquidity is going to the lower income groups.
So, Fiona, this is the chart that we were talking about, and it shows exactly what Jeff is mentioning, right? Which is Brent showing this unusually strong backwardation. And actually, if you bring it back, there are only 11 trading days since 2008 with an equal or stronger, second to third time spread. So how tight is this? Is there, have we seen any signs of demand destruction yet as prices soar, actually?
Well, if we look at the European power market, we've certainly started to see, signs of demand destruction. The same here in the UK, with some falling off of sort of manufacturing demand for things like natural gas. And I would expect that we may be getting close to that point in the oil market where we do see some demand destruction. But for now, again, as Jeff said, demand's incredibly tight. I've been amazed, particularly in the US, with the distillate demand, really illustrating just how strong the manufacturing and the transport sectors are.
Jeff, the call option activity is really exploding. What does it tell us?
I mean, the expectations of the market is substantially higher from here. Because I think what that's pricing is the asymmetry in the risk profile, because when your inventories are incredibly low, at tank bottoms, you expose the market to these upside price spikes. And that's what the option market is trying to price right now. But I actually want to emphasize here, the participation from the investor community is extraordinarily low. The liquidity is a fraction of what it was going back, let's say a year and a half ago. The investors have abandoned the space on commodities, equities, anything commodity related or old economy, which just creates more upside risk here at this point.
But when are you, Jeff, expecting some kind of, significant demand destruction?
It's clearly at higher levels from here. We think you get into that 105 range. Places like India, Indonesia, Brazil start to run into problems. We'll see what happens to the dollar in that environment, because if you get a weakening dollar, it buffers them and then the price can go much higher. But that's using historical relationships. And those historical relationships may not be appropriate here with the type of liquidity that's in the system.
Fiona, are we looking at a 2008 kind of shock? I know it's difficult to put, the price of oil, or certainly the oil markets, in parallel with the recession that we saw. But what parallels would you draw, if any?
I like to say,
I think it's
2000. Oh, sorry.
Let's do Fiona first, and then Jeff, you can come in.
Okay.
No worries. I think it's difficult to draw a parallel to what we're seeing now. We really are seeing very strong demand, but at the same time, we're going through this so-called energy transition. And that was not the case in 2008. So, we're talking about massive underinvestment in these so-called, bad sources of energy, of which, oil is at the top of the list. And so the situation is quite different than what we saw in 2008.
Jeff?
2008 was a financial crisis. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it. And it's, the backwardation in this market is an indication of just how different this market structure is from 2008. 2008, the curve was going up by the back end, dragging it up. It was in contango at some points in time, which tells you it was paper financial buying on the back end as opposed to outright shortages. This curve is it's super backwardated, and many of these commodities are super backwardated, which is textbook shortages. In fact, when Keynes created the idea of backwardation in the 1930s, this was what he had in mind, and we have not seen such types of backwardation. I've been doing this 30 years, and I've never seen markets like this. This is textbook shortages.
Yeah, and actually, let's bring back, I like your hand movements, Jeff, but I'm going to help you out and actually put that chart up, looking at the backwardation that we've seen. I think we're looking at Brent, and again, it's only 11 trading days since 2008 with equal or stronger second to third time spreads. There you go. You see it there. We'll have plenty more, of course, with Fiona and Jeff. Fiona Boal from S&P Dow Jones Indices and Jeff Currie from Goldman Sachs. Now, coming up, the West is in dialogue with Moscow, while at the same time depending on Russian energy. We'll discuss that story next. This is Bloomberg. We're also looking at the global bond round, definitely deepening as we have those job surges in the U.S. They're boosting rate hike bets, not only with the Fed, but also the ECB now coming into play. If you look at the spreads in Europe, they're widening. There's definitely a melt up with the Italian 10-year yield now at 1.841. This is Bloomberg. Economics, finance, politics. This is Bloomberg Price of Power, looking at the global energy crisis. I'm Francine Lacqua here in London. Now we're back with Jeff Currie from Goldman Sachs and Fiona Boal from S&P Dow Jones Indices, both still with us. Jeff, when you look at the concerns, of course, over Russia and Ukraine, with Russia saying, look, they're not ready to invade, but also the amassment of troops at the border, what does that do to gas prices going forward? And is it, is something ugly happening on the geopolitics already priced in? Or could we see real disruption?
Well, I think the probability of a disruption is still very, very, very low. We don't have data to go back this far, but I've been told the only time we've ever seen Russia stop supplies to Western Europe was the day Hitler invaded Russia, and was it 30, whatever. We don't know if that's true, but I tend to think, again, the game theory of that is probably true. It's mutually assured destruction between Western Europe and Russia. There's no, it's not in the interest of Europe to cut consumption of it, and not interest of Russia to cut the supplies. The market prices in the potential for, let's say an accident, the risk of an accident in Ukraine or something like that could be very devastating. But in terms of thinking about the implications of an outright stoppage, I go back to the idea, your game theory is mutually assured destruction.
Fiona, what exactly is priced in on the markets right now?
I think the market is pricing some risk, but it's certainly not pricing the worst case scenario. There is little incentive for it to get to that, and the market seems to be reflecting that sentiment.
Fiona, talk to me a little bit about some of the renewables. So first of all, on the subject of energy dependency, right? This month we spoke to the Ørsted chief executive, Mads Nipper, and he told us that solar and wind could offer a solution to the price swings we're currently seeing. So first of all, let's listen to the chief executive.
The fact that prices have spiked means that we need to accelerate the build out of renewable energy and therefore be much less dependent on gas imports from different parts of the world. Both wind and solar build out combined, hopefully also with more storage, is the solution to these price swings, not the reason for it.
Fiona, what kind of price or what kind of temperament do we need or temperance from renewables do we need to make sure that the energy prices stay on track?
Look, I don't think it's an issue of wanting the energy transition. The trick's in the title. It's a transition. It's going to take time. So I'm not sure even a significant spike in the price of traditional energy sources is going to be able to accelerate the build out of those alternative sources quickly enough. I think we're in for a pretty wild ride over the next few years as we try and move as quickly as we can to adopting more of those renewable sources into our global energy plans.
Jeff, I want to bring everyone's attention to a wonderful column piece that our Javier Blas from Bloomberg Opinion has put in place. And basically he says, look, the world needs to give up its addiction to fossil fuels. That's what a lot of governments want to do. But really, as the UK is discovering, it's not going to be easy and it's not going to be cheap. Do markets forget that, Jeff?
Yes, completely. I've forgotten it. And I think that, governments need to do this in a very global, uniform fashion, because, one thing about climate change, local solutions don't solve the global problem. We need a global carbon tax such that everybody's facing a similar type of tax. And as you want to reduce the overall consumption, you turn up that tax or that carbon price to achieve that. The problem with ESG, it's a blunt tool. It's cutting supply overall across all hydrocarbons at a rate that is too quick, and it creates the equivalent of a carbon tax where you don't collect the tax revenue and the price is substantially higher than what you would get under a carbon price or a carbon tax. So right now, we're not in an environment in which we're starting to create a organized way to reduce that dependency on hydrocarbons.
So, Jeff, we have some of the calls on where you're expecting them to go. When do you expect the price of oil, but also gas, to ease off a little bit? I know over the weekend we also had this big refinery outage in Texas, and the U.S. products market is already tight.
Well, in terms of thinking about the product markets, it's reflective of that strong demand, better than expected demand due to the fact that Omicron wasn't as severe as that. You also have outages of refineries. We have high carbon prices in Europe, making it more costly for refineries to operate. So you're exacerbating an already extremely tight product market, again, emphasizing just creating more upside risk in product prices as well as oil prices.
But Fiona, I mean, the role of OPEC, they said they will try and add more supplies, but actually so far they failed.
They sure have. My colleagues at S&P Global Platts think they're only going to do around an additional 200,000 barrels a month. So that's half of what they've said they've done. It's really only Saudi, the UAE, the usual suspects that have any spare capacity, and we shouldn't forget that these are country-specific quotas that they're working under now. So even if Saudi was going to increase production, it would be going against the so-called rules of OPEC plus.
All right, and let's also remind, of course, everyone that we talk about it from a trading point of view, but if you look at the U.S. pump prices, they've been the highest since 2014, and we have a great chart illustrating that as well. Thank you both for joining us for a spirited conversation. Fiona Boal, Head of Commodities and Real Assets at S&P Dow Jones Indices, and Jeff Currie, Global Head of Commodities at Goldman Sachs. Thank you as ever. Now, coming up, we stick with energy as we focus on a pioneering UK company that seeks to alleviate the country's growing gas prices from sustainable and green sources. That story up next. This is Bloomberg. This is Bloomberg Price of Power. I'm Francine Lacqua here in London. Now, Dale Vince left school at 15 to join the New Age traveller community. By 1995, he'd founded the British renewable energy company Ecotricity, which now supplies around 200,000 customers. In recent months, he's been calling for the government to impose a windfall tax on North Sea oil producers and for a public inquiry into the UK's energy market. Well, we're now delighted to be joined by Dale Vince with the very latest. So, Dale, thank you so much for joining us. If you look at what some of the governments have been put in place, some of the policies certainly that the Chancellor wants and the Prime Minister want, what do you think about the price cap and what the Chancellor wants in terms of bills?
I think the price cap has fundamentally caused the pain that we've felt in Britain, which is beyond the pain felt anywhere else in the world, I think, from the spiking global prices. Because by holding retail prices down, allowing wholesale prices to rise well above them, the government have forced companies to trade at a loss, and that has bankrupted 30 players in our energy market, nearly half the entire sector. So that's a fundamental problem. I think what the government announced last week, lending customers £200 to help them pay, which by then will be a £1,000 bill rise, is pathetic, actually. If energy prices are too high, government should actually do something about it. And of course, a windfall tax, we're seeing about 20 billion excess profits made in the North Sea. That would make great sense. It'd be very ethical to do that. Sorry, it was a long one.
So I guess, Dale, I mean, first of all, how do you think it will be easy for energy companies to roll out the discounts? And if you're asking for, a tax on something else, maybe it puts more pressure on the economy. So first about the rollouts and the tax incentives, how easy is it to do that?
It looks really complicated to me. It looks like it adds another massive layer of complexity to energy bills. They're already complex. It kicks in October. I don't actually know if the £200 is in one lump or if it's spread over 12 months, but we know that 12 months later, it has to be repaid at the rate of £40 a year or something, and again, probably spread over 12 monthly payments. So it looks very complicated and drawn out. And the 20 billion windfall tax is not going to be harmful to our economy because these guys in the North Sea sector weren't expecting to make this money. They don't need this money, and it won't harm investment in the North Sea.
So why do you think the government's not doing that?
I think the government are very close to the oil and gas industry. We subsidize it already. It was proved in court in Britain about 2 weeks ago that we put more money into the North Sea by way of subsidy than we take out by way of tax. So fossil fuels are a loss-leading product for Britain in the North Sea, and it doesn't make any sense. We should be spending that money on renewable energy. As a previous guy said, the Ørsted Kai, that's the way to solve the problem.
Yeah, I mean, we also have this great, and at times, Dale, I guess it's not as easy as people would want to. Or Javier Blas also wrote this beautiful piece saying, look, the world definitely needs to give up its addiction to fossil fuel, but as the UK is discovering, it's not easy and it's not cheap. Give me a sense of when you look at the discounts that you think are extremely complicated to roll out. Are you worried about the timeline that actually they get, you get the relief in October when we could see another increase in prices?
We will see another increase in October. I think that's pretty certain. That's why I referred to the £1,000 total bill rise by October. I think renewable energy, is often described as being not cheap, but it's the cheapest form of new energy that we can build, and we have to build new energy. And if you look at this crisis, this fossil fuel crisis this winter, this cost our country £20 billion at least. The bankruptcies in our energy sector have cost us another £4 billion. All of that money is wasted. We could have spent that money on infrastructure, renewable energy infrastructure, to help us reduce our dependence on global markets.
Yeah. All right. Thank you so much. Dale Vince there, of course, for all the green energy promises and plans. Javier Blas also argues that the current energy transition is just in its infancy. Dale Vince, he's chief executive of Ecotricity. Now, that's it for today's Bloomberg Price of Power special. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kaylee Lyons in New York. Anna Edwards is here in London. Huge yield moves, certainly when it comes to BTPs and bonds. This is Bloomberg.